Every quarter, governments around the world publish a single number that influences interest rates, stock markets, and policy decisions affecting billions of people. That number is Gross Domestic Product, or GDP. But behind this seemingly simple figure lies a remarkably complex measurement process that most people never see. GDP stands for Gross Domestic Product. It measures the total monetary value of all finished goods and services produced within a country's borders during a specific period. Two key words matter here. Domestic means within the country's borders, regardless of who owns the factory. And the word gross means before accounting for depreciation of capital equipment. A critical concept in GDP measurement is value added. Consider a loaf of bread. The wheat farmer sells grain for 50 cents. The mill turns it into flour sold for $1.20. And the bakery produces the final loaf at $3. If we simply added every transaction, we would count $4.70. GDP avoids this double counting by measuring only the value each producer adds, which totals to the final price of $3. There are three distinct methods for calculating GDP, and in theory, all three produce the same result. The expenditure approach totals everything that was spent. The income approach totals everything that was earned. And the production approach totals the value added by every industry. Most countries rely primarily on the expenditure approach, but they use all three as cross-checks. The expenditure approach uses a formula you may have seen before. GDP equals C plus I plus G plus net exports. C is consumer spending, the largest component in most economies. I represents business investment in equipment and structures. G covers government purchases of goods and services. And X minus M captures net exports, the difference between what a country sells abroad and what it buys from other nations. Consumer spending, represented by C, typically accounts for about 2/3 of GDP in advanced economies. In the United States, it is roughly 68%. This category breaks into three parts: durable goods like cars and appliances, non-durable goods like food and clothing, and services such as healthcare and rent. The dominance of services has grown steadily over the past half-century. The remaining components each play a distinct role. Business investment, around 18% of GDP, covers spending on factories, equipment, and inventory changes. Government spending, about 17%, includes federal, state, and local purchases, but excludes transfer payments like Social Security. Net exports can be positive or negative. The United States typically runs a trade deficit, meaning imports exceed exports, which actually subtracts from GDP. The income approach works from the opposite direction. Instead of measuring what was spent, it measures what was earned. Wages and salaries, corporate profits, rental income, and interest income are all summed together. The key insight is that every dollar spent by a buyer becomes a dollar of income for a seller. This is the circular flow of the economy, and it is why the income and expenditure approaches must, by definition, produce the same total. The actual measurement falls to national statistical agencies. In the United States, the Bureau of Economic Analysis, part of the Department of Commerce, is responsible. In the United Kingdom, it is the Office for National Statistics. These agencies gather data from thousands of sources: business surveys, tax filings, customs declarations, payroll records, and retail sales reports. No single data source is sufficient, so GDP is always a composite estimate. GDP is not published once and forgotten. In the United States, the BEA releases an advanced estimate just 30 days after a quarter ends, using only about a quarter of the final data. A second estimate follows at 60 days, and a third at 90 days, each incorporating more complete information. Annual and benchmark revisions can continue for years. It is common for the final figure to differ from the advance estimate by half a percentage point or more. A country's GDP can rise simply because prices went up, not because more was actually produced. To separate real growth from inflation, economists distinguish between nominal and real GDP. Nominal GDP uses current prices. Real GDP adjusts for inflation by applying a price index called the GDP deflator. When news reports say the economy grew by 2.5%, they almost always mean real GDP growth, with inflation stripped out. GDP is a powerful measure, but it has well-known blind spots. The informal economy, including cash transactions and unreported work, is largely invisible. Unpaid labor, such as childcare and housework, contributes enormous value but is not counted. Environmental degradation is ignored entirely. A factory that pollutes a river while producing goods adds to GDP without any subtraction. And GDP says nothing about how income is distributed or whether citizens are healthy and satisfied. Despite its limitations, GDP endures because no alternative offers the same combination of breadth, comparability, and frequency. It is calculated by over 190 countries using broadly consistent methods published every quarter and enables direct comparison across nations and time periods. Economists increasingly supplement GDP with measures of inequality, environmental sustainability, and subjective well-being. But as a baseline measure of an economy's productive capacity, GDP remains indispensable. Measuring GDP is an exercise in structured estimation. 3 complementary approaches, thousands of data sources, and a cycle of continuous revision converge on a single number. That number is imperfect, but it remains the foundation of how we understand and compare economies. The next time you hear a GDP figure in the news, you will know exactly what went into producing it.